Um, yeah, thanks, Yonok, for having me, and thanks everyone who came tonight for this presentation. I cast my mind back to 1 year ago when I did this presentation on IBM, and it was really to give, I guess, a case study on how a fund manager thinks about applying international financial analysis in the real world on a company. And I used IBM as a case study because the previous lecturer used to talk a lot about that. And today I've kind of, I'm going to give a refresh on the same lecture, but I hope that, I hope that you guys can come away, with a better appreciation of perhaps blending the academia with the industry. So just to get started, you notice on my first slide, this is, I put a slide on talking about the corporate life cycle of which every company goes through from growing to aging. And IBM is a company that started in the early 1900s, but now, originally in electric typewriters, but has now grown into becoming a very big multinational enterprise technology and services business with about 130 billion market cap, doing about 75 billion in revenues per annum and about 10 billion in operating profits per annum. So this is a very big company, and I've kind of circled in there that I identify it in this kind of period of aging of the corporate life cycle in recrimination and bureaucracy. And I hope kind of maybe in this lecture very quickly to talk about through how I think about why it's in this two phases of the corporate life cycle. So just very quickly about myself. My name is Michael, and I am an investment analyst at Antipodes Partners. Very quickly, Antipodes Partners is a $9 billion pragmatic value hedge fund. We specialize in investing in global equities across the world, so buying public stocks, both long and short. So we can make money from both share prices rising and falling. We have the word hedge in our name because we use derivative contracts to hedge tail and currency risk events. So we can buy put options and call options and other types of instruments to express a view to mitigate risk. So that's why we have hedge in our name. But beyond that, I'm also a private investor in Sydney Science College, which is New South Wales kind of first STEM high school that started up this year. And kind of my education background and affiliation with UNSW has been, I was a past leader in the past, teaching accounting 1B in a former life. And in a former life, I was a Bachelor of Commerce student majoring in accounting and finance, and now I'm currently continuing my education studying for my CFA level 3 exam. So that's just a bit about me. Talking about IBM as a case study, I pose a question to you guys all of whether this is a hypercloud or a hyperclown. So hopefully in the next few slides, you guys can come to a conclusion of what you think after I've talked about kind of my key points from international financial analysis. I think very broadly, accounting is very backward looking, unfortunately. I think that's historically what it's always been. Doing financial analysis, looking at past data. But I think what a lot of accountants can sometimes miss is thinking about the forward-looking data. So that's more intangible in nature. And it's more about assessing what the future possibilities of a company could be. And I think that's the harder element of financial analysis that that accountants don't often get. But I hope to pose this kind of way of thinking as a fund manager to you guys. So I kind of list 3 dot points about this IBM case study. One is about following the capex. The second is about this Red Hat acquisition that they did for $34 billion 3 years ago. And the third is about staff and management culture that's unprepared. So I just kind of want to talk about both about the capex, Red Hat, and culture. So at point 1, just a bit of housekeeping before that. IBM is a very complicated business. IBM has, let's call it 5 different segments to its business. But primarily, the way to think about it is there is an infrastructure layer. Then above that is a platform layer. Above that is software layer, and then above that is services. And it's kind of broken down into these, what we call 4 key segments, and financing is a separate component. But I think this slide hopefully tries to give you a bit of an idea about kind of the different segments there. But if you can just keep in your head, infrastructure, followed by platform, followed by software, followed by services, I think that's all you really need to know. And that is a business that, by the way, is yeah, I think there's a bit of hardware in there, there's a bit of software in there, and there's a bit of services. That's the other way you can think about it. But just moving on, kind of the first thing I want to talk about is when you look at the revenues of IBM across the different segments. At least this is for the fourth quarter 2020 results, but obviously more recently they just posted their Q1 results, which I'm happy to talk about in Q&A if anyone wants to ask about my thoughts there. But I updated this last weekend, so unfortunately the 1Q 2021 data are not there, but it's more or less the same. This slide basically tries to talk about the fact that the market sometimes forgets that IBM Cloud is not necessarily the same as Amazon Web Services or Google Cloud or Microsoft Azure Cloud. If you look under the hood, I suppose, and look at the slides, IBM defines 37% of their total revenues as what they call cloud, which is quite a big amount of money when you think about $7.5 billion. Because in the context of Google Cloud, which is or Azure or AWS, they do about 10-20 billion in revenues a quarter as well. So if IBM was in that same vein, then shouldn't it be the case that IBM should be valued like an Amazon or Microsoft? Well, the reality is it's only 130 billion, but Amazon and Microsoft are both $1 trillion plus businesses. So that's not the case. And when you think about IBM's cloud, 56% of that, which is, if you want to know the math, it comes from looking at 23 plus 33 here. That gets you 56. 56% of IBM's cloud revenues actually come from what we call consulting segments, so global business services and global technical services. This is more services businesses and not actually product segments. And it's quite interesting because when you think about cloud companies, what they provide, which is cloud service, is actually defined as a product. I think IBM often tends to try to lump a lot of their cloud revenues as a product when it's actually 56% of it is actually more a service than anything else. So it's actually not really comparable, although they like to think or let the market believe that they are comparable. So there is a bit of financial gimmick accounting that's going on that IBM is trying to do. And I kind of make it the point that Gartner, which is a third-party provider, does make the statement that since 2019 onwards, they don't even classify IBM in the cloud matrix. They actually just put it in the other bucket. So they've kind of given up actually trying to assess what is really cloud in IBM. And so yeah, I think IBM likes to sell themselves as a cloud play when really it's quite questionable what the cloud really is for them. Whereas with Amazon and Microsoft and Google, it is a lot clearer for the market. And when we talk about cloud, just for definition's sake, we are talking about services that allow workloads to be moved from on-premise to a data center somewhere else that's not on-premise. So that's kind of what I mean when I'm talking about cloud, for definition's sake. About the capex, which is what you learn from accounting about spending or purchasing of property, plant, and equipment or intangible assets. One of the things you can look at is capex as a percent of revenue. And an interesting thing you can find is when you look at IBM and also Oracle, which are what we call hyper clowns, you can see they're clowns because when you think about the capex spend that Google and Amazon and Microsoft have, they are orders of magnitude higher than IBM and Oracle. So you can see the differential there. Around 15% 16% versus, 2 to 3%. One would really question what is the capex spend that IBM and Oracle are doing to claim that what they're doing is cloud, when Google, Amazon, and Microsoft are spending way more and delivering similar cloud revenue numbers. So already you kind of get the sense that IBM is really trying to spin a story of cloud when it's not really cloud. I just want to make the point that obviously within that capex number, just to be clear, it is a total capex number. So it could also be affected by finance leases and finance and operating leases. But even if you adjust for that, it's still more than 10%. So that's just something to note. But the capex doesn't tell you that IBM and Oracle are really competing in the same level as a Google, Amazon, or Microsoft on cloud. So that's this slide here. Now we're on to point 2 about Red Hat. So Red Hat is the owner of the Linux operating system. So the biggest operating systems in the world are Windows and Apple operating systems. And Linux is kind of an afterthought, maybe 5 or 10% of the market share globally. But Red Hat owns that. And Red Hat is a very big business, used to be publicly listed. And I like to make the point that IBM actually bought a very underperforming business out of desperation, which is Red Hat, for $34 billion in cash and debt. So if you look at the slide here, they actually missed their Q1 street estimates on their revenues for Red Hat. And you can see the share price decline was quite massive, from 180 down to 120, which is about 33% down after missing a quarter. And then again, on the second quarter, they missed again. And the share price goes from maybe 150 down to 120, which is another 20% decline. And obviously they disappointed the street with top line growth that was actually decelerating. So the year-on-year growth numbers were actually decelerating from I think about 17% to 15%. And the market wasn't happy about that because they expected this is a software business that should be growing way faster than that. And after such a big price decline from 180 down to 120, I think what basically happened was they had a call with IBM, and then IBM ended up making the announcement in early 2019 to acquire Red Hat for $34 billion. And if you go to the next slide, the reason why they bought Red Hat is really because, like I said, it was out of desperation. IBM is an interesting business where they don't like to rely on other third-party operating systems. They would obviously like to sell their own operating systems because that means more of the revenue can be kept for themselves. And so that is the reason why they wanted something like Linux operating system. And so when they bought Red Hat, where they really sit now, if you look at the picture on the right, is to show you that using Red Hat, they want to sit kind of behind the cloud infrastructure of AWS, Azure, or Google Cloud. But really, that doesn't actually change the fact that they don't actually spend that capex to build data centers, but they're really just leveraging their relationships to be a cloud reseller. If you think about it, these are the actual cloud guys. And this is really just a reseller of the cloud, they have the cloud, but then they just resell it. And I think that's the reason why they wanted Linux in the first place. And unlike those other companies, really successful software as a service companies that have built themselves on top of the cloud, like Datadog or like Splunk or like Elastic, IBM is actually doing the opposite. And they're using the Linux operating system to force their customers to be locked in to their operating system. And they're often just serving them mediocre and often free middleware. So all the software applications that go on top of Linux operating system is very mediocre, and it's often actually free. It's actually open source. A lot of it, like OpenShift, for example, is actually a free software that can be used, and you don't actually need to be paying IBM for that. But if you're on the Linux operating system, they will force you to pay to use those software tools. So there's nothing really much of a competitive advantage here in what they're doing. They're just doing reselling of cloud service. That's all it is. When really the fundamental cloud guys are these three players here. And I tried to talk about this on the other side, on the left-hand side, you can see where really, the Red Hat and IBM picture here is talking about the platform layer and the software that they're trying to sell on top of that. And of course, on top of that, they're trying to sell their services and lock you in because you're going to be stuck on a Linux operating system. But you can see that, they have very subscale products from Red Hat, and often they're free, and they're trying to lock in customers when the rest of the market is actually trying to keep the market open source and allow everyone to kind of build on top of the cloud and not be locked in. I think that's kind of opposite to what IBM is doing, but it certainly does disincentivize new customers from joining in that case, because often lots of companies are trying to go hybrid cloud and not want to be locked in. So that's kind of a talk about Red Hat and the acquisition there. And finally, on point 3, just a bit about culture, just conscious of time as well. This is more very forward-looking data based on obviously human capital and an understanding of the business. My father used to work at IBM for 20 years, and I used to work there as an intern with my dad 6-7 years ago. And when you start to understand the culture of IBM, IBM, for back in the 1970s and 1980s was an incredible business. Back then it figured out a way to sell mainframe computers, which are these very big computers that they would sell to companies for a few $1 million. So not everyone could afford that stuff. But obviously, once Bill Gates came in with once Bill Gates came on with software and built it on top of personal computers or laptops and computers you could use at home, people then realized they didn't need to spend millions of dollars at IBM to buy a mainframe computer for their home, and that was when IBM started to suffer in the 1990s. But they had a CEO called Louis Gerstner who came in, and through understanding that the business realized that they had no advantage in selling hardware that was millions of dollars, and they also didn't have any advantage in selling software on top of Windows operating system because Bill Gates had beat them there. But what he found was, through feedback from customers, was that IBM is actually just a services business fundamentally. The best thing it can do is leverage its relationships that it has with existing old world customers like airlines and banks, and then try to help them in technology services like building out, software or doing digital transformation implementations. That's all they can do fundamentally. So when he did that, obviously the stock of IBM actually took off very well. And I think, unfortunately, what happened then is, after Louis Gerstner left, if you take a step back in history, Pal Masano and Gina Rometty were the next two CEOs who came after. And they basically morphed IBM from what was once a business with genuine engineers to one that was very much full of financial engineers, and started focusing almost incessantly on this idea of the earnings per share, a $20 EPS target. And the problem with that was, the way that they did it was they focused actually less on what happened was, in order to meet those EPS targets, they did a lot of offshoring, and that actually meant 200,000 staff was actually relocated offshore into much cheaper labor locations. The problem with that is, once you've lost all that talent, the very thing that you're built to be good at, which is services that Louis Gerstner had set up years ago, has now been lost, because now you just have, you have offshore people who, are probably in different time zones, who also may not be speaking the language as good. And so, you lost your very own competitive advantage there when you tried to focus on that EPS target. And so, that has obviously been the downfall of IBM if you look at the share price over the last few years. And, needless to say, there is now another new CEO, which is Arvind Krishna, since 2020. And, he comes from the cloud and cognitive segment of the business, which is known for IBM Watson, which used to claim that it was going to be the AI model that was going to cure cancer, but never did, because otherwise we'd all be healthy. But he came from that segment. And, whilst it is, I think, a step in the right direction, I think, having worked there at IBM personally, and knowing from my father's experience at IBM, we kind of get the sense that, you know, over decades from Palmisano to Remedi, IBM has been actually built on a culture that is unfortunately, you know, structurally unprepared for the cloud megatrend of the 2020s. You know, they're nothing like AWS or Azure or Google Cloud, as I said in point one. You know, they don't spend nearly as much capex. You know, the Red Hat acquisition really is out of desperation, and they only got products which were really subpar, and a lot of it's free anyway. And, you know, I guess the only good thing that's come out of the CEO so far, from my point of view, is, you know, they're spinning off their managed infrastructure business, which is probably the most capital intensive part of the business, because that relies on, you know, a few data centers that they have with lots of server racks. But apart from that, my view is that, you know, from all my analysis, is that IBM is not ready culturally, and, you know, selling managed infrastructure is really just kind of a temporary fix to, you know, short-term financials, but doesn't really fix the long-term culture problems that have been around for the past few decades. So this is kind of one example of what the street is focusing on from the first quarter results for IBM from Evercore ISI. I think it's quite interesting to note that a lot of the market, you know, despite everything that I've said fundamentally about the business, you may have noticed that, you know, post the first quarter result on Monday night, the share price did go back up, and you may be thinking, okay, well, Michael's talked about all these fundamental problems and this reasons about why IBM is a hyper cloud with all his analysis, but the stock actually still went up 4% on the day, and I kind of, you know, try to, you know, tell people that there is a difference between, you know, financial analysis and also also what the expectations of the street are. You know, analysts have different estimates on the street, and even if the results are bad for a business, even if they're better than the street and they're not as bad as the street thought, the stock prices can still go up. So this is kind of just a small plug into a kind of the analyst's view, which is kind of where I'm involved in hedge fund world. But I guess to conclude, this is a slide that I showed back in 2019 UNSW lecture in the same course that I did 2 years ago. And, you know, nothing that I say here tonight is financial advice. I would just say everyone should just do their own research before making investment decisions. But, you know, this is the exact same slide that I showed where, well, back then I was talking about companies that had very strange financials, which were Domino's Pizza and Reliance Worldwide. But I had the same concluding slide, which talked about the common red flags that can be found in companies that are possibly fundamentally flawed businesses. So, you know, I find it interesting that I've highlighted in yellow the things that I found that IBM have gone through recently, which have included a change in the CEO, you know, a change in business strategy, which has obviously come from now a focus to cloud and cognitive rather than managed infrastructure services. You know, an M&A being done, which was actually the Red Hat acquisition and integrating that, but also a lot of the negative publicity that has come with IBM over the years, ever since they've done all their offshoring of their staff. So I found it interesting that, you know, there does seem to be a lot of red flags, at least from my analysis, and you know, I think with that, hopefully you guys can probably come to your own conclusion about whether this business is a hyper cloud or a hyper cloud. But I think that is the end of my main slides. And Yondok, I'm happy to take any Q&A if you have any time. Thank you, guys.
Okay. Thank you for the wonderful presentation for the analysis of IBM, and thank you for sharing your personal experience as well. Do you have any questions about IBM? If you have, write down your question in chat function, then Michael will be answering that. So I'm gonna receive 1 or 2 questions from students.
That's fine. If nobody has questions, I'm happy to talk a bit about the first quarter result, but that's up to you, Yondok. If you have any questions yourself, you know, you can feel free to ask as well. You can.
So in your hedge fund, do you have any exposure for this IBM as investments?
The answer is yes. We have a short position on IBM. So
Okay.
we just to explain for people who may not understand, when I say short position, it means you are selling high and buying low. So
Yep.
the way you can sell high is we borrow stock from a counterparty. So it's often an investment bank who has stock in IBM, and they're willing to lend it out for interest or borrowing cost. And when we borrow that stock, we'll sell it straight away. And with the idea that hopefully if the share price goes down, we can buy back the shares and make the profit, which is the spread. And then we just return the shares back to our counterparty. We do have a short position on IBM. We've had it actually since 2 quarters ago. And 2 quarters ago, it was a lot better. The share price, in both those quarters, in Q3 and Q4, actually underwhelmed the market, on the top line revenue growth. And, stock actually fell, I think 9% on Q3 and I think 4% on Q4. But, unfortunately in Q1 this year, stock is up 4% because it wasn't as bad as the market thought. But yes, we still do have a short position on IBM.
Okay, good to know that.
Yeah.
And so you are also the CFA, the level 3 candidates, and many students are interested in the CFA program. So do you think the CFA is viewed as a positive indicator in the industry or job markets?
That's a good question. I think for at least from my personal experience in funds management, for any of those students here who are possibly interested in working in a hedge fund, I think CFA charter is looked upon, I think, well. I think if you had to choose between 2 candidates, ceteris paribus, both equal, and one had the CFA charter, you just take the one with the CFA charter, is what I would say. It doesn't mean it makes you a good investor. Nothing of that, I think. No, I would say the CFA has, I think, is maybe one of the only courses that I found that blends all the university courses at UNSW, like finance, accounting, economics, management, together into one exam. I don't think there's a uni course that does that. But CFA charter, I think exams do test you on a broad range of topics in business that I think just help you, I think, in terms of understanding the jargon. And I think just in terms of, I think, just being able to communicate better with, I guess with, obviously your colleagues if you work at a hedge fund. I think that's probably where I see the most benefit from, studying my CFA exams. But I would recommend it to those people who are maybe thinking about coming to my industry in hedge fund world. I think considering that, taking the CFA exams as a way to, I think just to improve your employability, I think that's a good choice. I think if you're doing it for that purpose, I would say.
Okay. Thank you for the comments. The final question from the students. Is there any question? This is a very good time, great opportunity for you to ask to the investment analyst directly. So if you have any questions, just let me know.
I'm happy to talk about my first quarter results on IBM because I know that's been quite timely. I know, I think if anybody has a question, just let me know. But I mean, I kind of want to talk about it because the data is a bit outdated now, again, just because it was Monday night when it reported. But I think it was an interesting read through because IBM, did perform better than the market expected because the revenue growth was only down 2% year on year. When the market was expecting, I think maybe 3 or 4% down. So that's why I think the stock was up 4%. A lot of the revenue growth was actually driven by a surprise in systems revenue. So that was actually what surprised the market. It was actually better than expected because I think they sold a lot more mainframes than expected. I would say though, the mainframe business is actually very cyclical because they come in product cycles. So this is one of those things where when they have a new product, it will spur revenue growth for maybe a few years, but then it starts to die down. But I think mainframe revenue growth just surprised a lot of the people on the street. So that was why I think that there was a surprise there. But we know that's cyclical. It's not really structural. I think the more structural businesses that I tend to look at is the cognitive business, which obviously has cloud and data platforms and transaction processing. That's more structural growth and is generally very consistent. And that actually didn't do too bad. Same as consulting or GBS, Global Business Services. That actually, I think maybe grew 1 or 2% year on year. So that was also quite surprising. I think most of the focus of the market though was actually less about the results of Q1 and more about whether they were going to say anything about the full year 2021 guide, and they didn't change it. So free cash flow guide for 2021 is still $11 to $12 billion. That hasn't changed, and revenue guide for I think 1 to 2% growth hasn't changed. So yeah, I think it was affirmation that even after Q1, they didn't have to change any of their estimates or downgrade any of it. So it does suggest a bit of confidence there. And I think I will say what's interesting in IBM is they recently changed their executive compensation. So their incentives are now more tied to, I think actually the revenue growth than the EPS. So for 10 years, like EPS was what I said, the $20 EPS number, which Ginny Rometty had, the previous CEO. She was focusing on that as the incentive for management bonuses. But now, actually, it was only maybe a month ago when they went through a proxy vote and they changed the compensation to focus again on mid-single-digit revenue growth. So that's now what Arvind Krishna, the CEO, is tied to. So you could argue that there is some, I think, fundamental change in what's important to IBM now. And yeah, obviously, I think the market is still waiting on an update on when the managed infrastructure service business, which is part of GTS, will be spun off. I think we're still waiting for the details there of what the numbers exactly are. But yeah, I think we haven't really gone more detail except to say that it will be completed by the end of 2021. So overall, it actually wasn't too bad a result. But if you go through kind of my thought process of the fundamental flaws of the business, like the very little capex they spend, the Red Hat acquisition they did for a very overpaid price of $34 billion, and I think the underprepared staff and management culture. I think we still stand by our short position. But yeah, certainly maybe the market in the short term doesn't see it that way. But that's just kind of my 2 cents on the first quarter result in IBM. Yeah.
Okay. Yeah. Thanks for the most recent updates. Yeah.